Hello, everyone, and welcome to this evening session, or at least it's evening for us here in the UK. I know lots of you join us from all parts of the globe, wherever you are. Thank you so much for taking some time out of your, out of your day to join us this evening. It's with me, Anna, and of course my husband David, who is sitting almost next to me on the other side of the room, where we are going to look at the markets, what's been going on today, what is likely to be going on later, and also look at perhaps at some macro and some fundamental data as well. But before we start, can I just draw your attention to the disclaimer that I know you can see on your screen? As you know, trading and investing can be a very risky business, so please don't ever think of using money that you cannot afford to lose. A session split between myself and David. It's usually into, there is a recording, it's been recorded as we go along, and then the recording will go up on a couple of YouTube channels, my own, which is Anna Coulling, and also the quantum trading channel, because I know we have a lot of you have already quantum trading indicators. Some of you are also us Forex students, and hopefully when we launch our stock program, you will also join us on the stock program as well, which we are coming very close to launching. Everyone has been so patient, but it has been as David says, a pretty monumental effort, but we're really proud of it because we know we've included everything that we believe you need to know to succeed in this business. So let me just take that down because we want to crack on. Of course, if you've got any questions, please just drop them into the chat box. We'll be more than happy to answer them for you. On anything we say, we'll be looking at charts, so please don't worry. And of course, we will be looking at charts through the prism of volume price analysis. What else? The best methodology out there, even if I say so myself. But it's not just me, it is literally the hundreds and hundreds and hundreds of emails that I've received in the last however many years the book has been out there. I think it must be running into thousands there of traders who've adopted VPA, made it their own, and run with it and succeeded with it. And those of you who maybe follow me on Twitter will know that I retweet when traders let me know what they're doing, what they're trading, and it's just been a joy, an absolute joy to see so many traders and investors succeed, because it is a really tough business. You would think it would be so easy. All you're being asked to decide is this going up or is this going down? It's a binary choice, but oh boy, there is so much more to what we see on the chart, as you all well know. Before I just give a very quick roundup and also what we're going to look at today, this is from FinViz, fantastic platform for all sorts of things. It keeps you up to date with what is happening across the markets, not just in stocks. We also use it as a stock screener, and it's one of the screeners we suggest in the program, primarily because it's free. There is a free version. I actually pay for the premium. I think that the premium gives you a little bit more functionality, and also the data is kept up. It's in real time. Otherwise, the free one is on a slight delay. But for the purposes of what we want for this session, it really kind of tells its own story, really. This is the S&P 500. Some quite dramatic moves. We can see Microsoft here up quite strongly. We are in earnings season at the moment, obviously. That Microsoft came in really strongly yesterday. Google wasn't so bad, but it was really, what really did for Google was I think they said that their cloud business is not going to expand as much, so they've really been punished at the moment. But the one also to watch is Meta. We are going to be having Meta results later on once the market is closing, so they are reporting after the bell. So that's the sort of general picture at the moment. I'm just going to be using TradingView today. I'm not sure whether I'm going over to MT4. I was going to look at some Forex as well, but actually there's so much going on at the moment, and the markets are weird. I think that's the best way I can describe it. In fact, I did a podcast the day before yesterday with a couple of guys who have interviewed all sorts of people in this business, and one of the contributors is actually a market maker. You don't know his name. He is incognito, as it were. He's known as a JJ. And even he said, been in this business for 20 years now, even longer maybe, that's the only way we can describe these markets at the moment, because there are so many people out there who are saying the markets should be doing this and the markets aren't doing this. And by should, I mean, given the background, given the geopolitics, given the structure of the markets themselves. And here I'm talking about equity markets. They don't seem to be performing how one would expect them to. But this is part and parcel of what you have to accept, in that there's an awful lot of what markets should do and what they should be doing. But in fact, what they actually do is what you trade, and you trade what you see on the chart. And sometimes it can be completely contra to the noise, if you like, the chatter, the media, partly because they're manipulated, as we all know. But secondly, there isn't always a direct connection at the time between what may be happening in the wider world, or even with the fundamental news and the macro news. So, as I said, we've got, at the moment, I think you can kind of divide the market up into two main narratives. One of them is, as I said, the geopolitical. We all know what the geopolitical is. We've had Ukraine, and now we've got the Middle East joining in. We've got all sorts of threats. Who knows where it's going to go? We can only hope and pray that there is some kind of resolution, and we all return to everything just calms down. But we don't know. It's not only markets are inherently uncertain, but we have even more uncertainty than we had before. But kind of rising above them both, the geopolitical and the other side, the other second narrative. I'm sorry, I should have said the second narrative, which is the inflation, which is the interest rates, what the central banks are doing. Is there a recession coming? Are we in a recession? And if there is a recession, is it going to be this year, or is it going to be next year? But rising above that is the kind of stock market. And here I'm talking about the US stock market in particularly, which I know it's pulled back slightly. I know we've had, some down days. It's kind of carrying on regardless and not reacting, as I said, as a lot of people have written, and I've seen it on my X feed, and I've seen media articles. Well, why isn't it doing? Why isn't it doing this? Because this is over here, and it's very, very perplexing. And even when we look at some economic data, I'm not going to go through this week's releases, but I'm just going to take one as an example. If you take consumer debt, again, this is in the US, there's a lot of stress. For example, the latest one that I came across is on car loans. The defaults are at a 29-year high. I mean, that's just horrendous. Mortgage rates are at, I'm going to say, an all-time high, but they are higher than they've been since, I think, 2007. They're something like 8%. So that's going to impact the housing market, and people are unable to move, especially if they're on a fixed-rate mortgage. And if you want to buy a house, what are you going to do? But then I look at the new build data that came out today, and the numbers are up. So what's all that about? It's all very, very curious. And then tomorrow, we have advanced GDP for the US, and that's actually going to show that the US economy, which is the world's largest, probably expanded at the quickest pace in nearly 2 years during the third quarter, whereas over here in Europe, and certainly here in the UK, where pretty much stagnant. And over in Asia, China at the moment is having all sorts of issues. So, the good old US of A just keeps marching on. And the stock market, or at least those indices which are featured in the media as kind of representing the economy, seem healthy. They're moving up. But if you've come along to any of our other webinars, you'll know that the S&P and the NASDAQ, they've just been driven higher by what are called the Magnificent Seven. And that is the result of these two indices. They are market cap based. So the biggest companies, according to market capitalization, have the biggest holding. They carry the biggest weights. Now, that is not healthy, and that's one of the topics I discussed the other day in this podcast. There are advantages to having market-based indices when the market is doing well, and a solid bull market is a bull market where the small caps and also the equal weight indices are all kind of moving along together. We are not seeing that. And at the moment, what we have is these two indices driven higher by the Magnificent Seven. I'm sure you all know who the Magnificent Seven are. And if you came along last week, you will know that I've actually created an index of those Magnificent Sevens, and I'll pull it up again. I've done it on TradingView, because if those 7 stocks are doing well, then the market is doing well. It is distorted. It's highly concentrated in these 7 stock. Market breadth isn't particularly good at the moment. There are still advantages to having market cap, and certainly if you're a passive investor and those indices with the biggest market caps are doing well, you're going to do very well, certainly when you compare with the equal weights. And when the market is generally doing well, then they'll motor on even more strongly. And in a way, when the markets aren't doing so well as they're doing at the moment, they kind of prop it up. But it's a bit of a false picture. For traders, for short-term traders, whether you're intraday or you're only going to be in for a few days, it really doesn't matter. But as long as you keep an eye on the kind of news releases, the bond market, obviously, what the Fed is up to. By the way, Jay Powell is up later. You just look at the chart and you trade what's on the chart. But it's really not so easy for investors. But this week, what I want to do, I just want to recap again on, whilst all this is going on, well, what can you do quickly to have a look just to see, are we at the point where the market is likely to turn? Either because from a geopolitical perspective, or, as I said, from the inflation narrative and everything else that's going on in the financial markets. And I want to look again at volatility. I'm not sure if I showed this when I mentioned it the first time. This is the ratio. This is a ratio of the VVIX and the VIX. And just to remind you again what the VIX is. I'm sure you've all heard the VIX, and certainly if you trade the S&P, the SPX, or the SPY, the VIX is the one chart that you must have on your screen or at the same time. The VIX is the implied volatility of put options for the S&P 500, while the VVIX is the implied volatility of the out-of-the-money put options on the VIX itself. So it's called the volatility of volatility. And you have to just remember a couple of things. For the VIX, because this the VIX and the VVIX, they're mean reverting. So they have a mean, an average, and then what they do is they expand and contract away from that mean. So you just have to bear some numbers in your head. For the VIX, it's 19. That's the kind of average. And the VVIX, it's 88. But the relationship between the two is actually quite interesting. They move together about 75% of the time, and the rest of the time they actually diverge. The relationship kind of changes all the time, which is why traders and investors monitor the ratio. The ratio is very easy to calculate. You just divide the value of the VIX at any point in time into the VVIX, and it gives you this number, which we see on the side. And then we look at the extremes for the ratio, and we then look at what is the sort of average. And we can see here, if we take, this is the monthly chart, and if we look at March 2020, we know March 2020 was when we had that sort of crash because of COVID, and it went down to, what have we got here? We've got about 2, and I think even below 2.5. So we know that was at an extreme point. Then we go back the other way, and we look at where we have here. Where have we here? We're at over 10, which was January 2018. When it's low, it's like the VIX. It's what am I trying to say? Yeah, it's max on here. It's panic. It's the markets are collapsing. When it's up here, it's maximum complacency. So it's actually the reverse of the VIX, because this is the ratio, and the average is about 5. So when it's here, what it's saying is that the risk dynamic is kind of normal. Now, markets aren't normal, but the risk of the market is perceived to be, it's may not be okay, but it's what it is. So is there a reason to panic at the moment? No, because mega panic is when it gets down to these levels down here, as we saw back in 2020. So it's a really easy ratio to understand and to monitor, and you read it just like any other chart. I've got my support and resistance here. You can see it bounced off 7 in January 2021. As I said, this is the monthly chart. If we actually go to the daily chart, which is really what we want to monitor, the weekly and the monthly are useful for levels, because it's now moved into areas where you would have to draw the levels in manually, and it kind of really, if you go onto the faster time frames, it tracks, if you like, what the movement in the S&P 500. You can't. This is mean reverting, so it's not really about it. It is direction, but at the same time, you have to remember you should keep this on a separate chart and just know the values. And if the values are falling and rising, then when they come to key levels, just be aware of what the ratio is telling you. So that's the ratio. This is my version of the Magnificent Seven, which is actually the 7 stocks that I've created my own index for. And we can see today it's not been a particularly good day. Yes, we've had this a pullback, but generally, there has been a bit of a pullback. But what's it actually saying? They're going sideways. Yes, they have fallen, but they do keep trying to rally. And the level you'll be looking for when if and when there is a bit of a washout is here, which is this value here, which is 1645. I have no idea what that value signifies. It's just a level. TradingView has created this for me, and because I like to trade the YM and sometimes the DIA, but mainly the YM, I've actually created my version for the YM, because that's a price-based index, not market cap. And the top 10 stocks, which I've included in this index, they carry a 56% weighting of that index. So if those 10 stocks are moving, then that gives me a pretty good idea of what the YM is doing at the same time. Right. What I've also done on this with TradingView is I've actually moved to a black background, because I think it looks better on the screen. And just to recap, for those of you maybe coming along for the first time, the FANG is it's an index that's produced by the ICE exchange, and that too is the top. I think it's the top 10. I've only got 7, and it's the top 10 stocks across the S&P and particularly the NASDAQ. Again, it's those stocks that are driving the markets higher at the moment. So a bit of a confusing picture. We're not looking at bonds. The only thing I would say about bonds is what yield to look at the moment. The 10-year, everyone looks at the 10-year, but perhaps the 2-year is probably quite interesting, simply because the Fed, if you recall, sometime, I think it was earlier this year or maybe earlier, Jay Powell said that they paid very close attention to the spread between the 18-month and the 3 months. So the 2-year is pretty close, and it seems to react pretty well with what is going on in the equity market, which is why I just keep an eye on it. And as you can see, there, everything is up at 5% and slightly beyond. So when this falls, the markets do tend to rally a little bit, or at least those 7 stocks that are driving the markets at the moment. What I've done is I've changed also the configuration of my charts on TradingView, because one of the principles of VPA is multiple time frames and also support and resistance, not just the support and resistance that you see on the chart that you are trading, but also support and resistance across key time frames. I have here the daily, I have the hour, and I've actually got the 3-minute chart here because we've had some very interesting price action on the SPY. The daily we always need to know, because we want to see, first of all, what the volume has been in the previous sessions. Is it above average? Is it below average? Or is it just average? And so that's the first thing to bear in mind, because we can tell from our volume bars whether the volume is going higher or lower. But it's interesting also to have an average metric, and you can find that at either FinViz or bar chart. And what's interesting about the price action ever since the failure to take out the 430, this level here, it's around 436, 437. You can see the number of times it was tested, and if you have the accumulation and distribution indicator, every time a level is tested, it gets thicker. And that gives us a very strong visual picture of just how strong that level is and the sheer amount of effort that it's going to take to break through. So it oscillated around there. There were trading opportunities, I have to say, to the both sides within those individual candles. And then we had the break lower, and it was refreshing to see we had the break lower and we had a lot of volume. We had a lot of volume falling lower as it went low, which is what we want to see. But you do also have to bear in mind that we had the expirations as well, so that would have bumped up the volume as well, because volume is relative, but it's also contextual. So you have to sometimes be aware of, there's high volume, but for example, is it a seasonality factor? Is it OPEX? Are all these option contracts expiring? And that certainly had an impact. It took it down to I've got the 200 MA on here, and I like to have the 200 MA, particularly when the price action is coming up to it or it's around it. And in fact, there was a follow through, but it went down to this level here, 417. You think, well, what's significant about that? You then have to move up to the weekly chart, and you can see that, yes, we had all that volume, but it was also Friday. There was a lot of options volume. There is a very strong support level on the weekly chart. So is it perhaps not, it's not surprising that not only was there a follow through, but that's where the support was. And in fact, this was Monday. There was, it's very hard to look at that candle, but all I would say, it was two-way price action. You have a wick to the top, a wick to the bottom, and it kind of ended as a doji. But it was sufficient to bounce higher yesterday. But look at the volume. Again, if you're going to move higher, you are going to have volume to push it through. Yes, we've got a tiny little wick under there, but we also then have the 200 MA coming into play. So you have your price, you have your volume, you have your support and resistance, you have your multiple timeframes, and then you have perhaps something like the 200 MA, which is referred to in the media. When we first started, moving averages were, oh my gosh, no self-respecting analyst or commentator in the press mentioned a moving average. That's what those idiots who used technical analysis did. Technical analysis is voodoo. It was a self-fulfilling prophecy. Well, maybe it is, maybe it isn't. But boy, oh boy, the price action does respect the 200 MA, and we just have to respect it as well. So what has happened today? We have had a down day, but we are back to the support level. What are we going to see tomorrow? Is this going to hold? Certainly on the daily chart, all we have as a support, we have a pivot, we have, this is the outermost level from the volume point of control, which is back up here, which is the yellow hatch line. All I can say is on the weekly chart, it looks okay. I know Google had a bit of a bad day. Microsoft's had a good day. We've got these earnings, we've got earnings season coming up. But we have two other factors, geopolitical notwithstanding, is we have the seasonality coming towards the end of the year. Traditionally, we have a rally going into the end of the year. We also have speculation that the Fed is going to pause again. It's not going to raise interest rate, despite, inflation. Well, inflation figures for the US are kind of okay. The labor market is still very strong. GDP looks good. In a way, they say, well, look, you've done your job. Why don't you take your foot off the gas, as it were? The market is always looking forward, as it were. Plus, we also have stock buybacks, where companies will buy back their stock to support the stock. And if they've had a good earnings season and the price, it's all looking healthy and their debt's looking healthy, why not? It's what they do. All those factors are going to support the market. That's assuming it's not just the 7 stocks that are propping up the market at the moment. So that's the picture looking at the daily chart. Let's go back to the 3 charts and see what else we have. What I have here is the hourly chart. And on the hourly chart, I like the hourly chart because I use the Camarilla, and the Camarilla values for the hourly chart are values that are in play for the whole week, whereas the ones on the daily, they're refreshed every time there's a new session. And the price action will respect these levels. So often what you see on a faster chart, and you think, oh, why did that suddenly stop, as it were? And you don't seem to be able to find a reason for it. Well, sometimes going on to the daily is too slow, so you go to something like maybe the 30-minute, but I prefer the hourly, because with this particular indicator, its values on the hour up to the daily, which are the same, below the hour, i.e. the 30, they will refresh every day. And we have a really nice example here. We have this shooting star candle. It was actually at the close. It hit the third level. The third level is the third levels on the Camarilla and the 4th are probably the most important. But the price action can react on all of the levels. We haven't quite got to the S3 here, which is at 416, but it's very close to that level on the weekly chart. So as I said, looking up and down the price, the time frames will be able to give you really a picture of where you might think you want to sell against a level, or certainly as a target for a price. It may not get there precisely, but it's an area, it's a zone. I mean, these levels, they're nice to have. They're certainly helpful and useful to have on your chart, but you have to give them a little bit of leeway. And if we go down to as I said, on the 3-minute chart with today's session, I did have the 5-minute up as well. Let me just start with the 5 because that's what I normally have, and I just went down to the 3 just to expand on the actual price action. And setting aside the pre-market and having a look at the open where we had, that's why I went to the 3-minute, because it is very, very volatile. You have volatility candle after volatility candle after volatility candle, and you have a bit of a pullback. You can see there you've got that on falling volume, so that tells you it's not going to go up any further, and then it comes down again, and it comes down to this level here at 419, and we have some consolidation, and you think, oh great, maybe you don't go in the first 45 minutes or so, you wait till it settled down. You think maybe I'm going to get a reversal. Well, that's not going to reverse from there. You get another candle, then you get this consolidation. But the move higher is horrible on the 5-minute chart. Yes, it's a move higher, but every time you get this volatility candle like this, you are getting a lot of chop and a lot of whipsawing. Also, you're running into the volume point of control. If you looking at the daily chart, and as I said, it ran into the 200 MA, you think, yep, I've got enough there to give me a view that I think this is more to the downside than the upside. Yeah, this is an interesting reversal, but it's horrible. Then you wait. If you look at that, which is at the open, as opposed to that, this is what you actually want to see. Any move in any instrument on any chart, you really want it to be, you can't always get it smooth, as it were, but you just want it steady. One of the things we say we explain in the program is that you can get volatile trends. You can get trends without volatility. You can get congestion periods with volatility, congestion periods without volatility. They kind of, markets move in a number of different ways, and you then judge it how far that's going to go based on the support and resistance. But by having the price action like this, the nice thing about TradingView is that your crosshair, you can actually see at a glance as you move across. It makes it a lot easier to monitor. That's what I have found, and it's maybe something you would like to consider. But if we move down to the 3-minute chart and expand that piece of price action that we have here, really the most interesting thing when we were looking at the potential of moving lower is to consider, well, what's the first thing that that strikes you? You look at that and you look at that, and that is so out of whack because it's clearly an anomaly. And you look at that level there, which is 421. 421 is actually where the 200 MA has been. You say, okay, I don't think that's going to go higher because it's such an anomaly. It's just not genuine. But I'm not sure yet. I just want to wait. you know 420, 421 is where the 200 MA is, and you think, yep, maybe that's where I want to sell against, as it were. What do you have here? You have, but not the first time. What happens is it does go down, but the volume also goes down, and then it tries to rally again. But there's not an awful lot of volume under that up bar, and it hits that level again, and then it actually gets underway. And then you monitor it simply. So if you take that as your primary trend, and then any pullbacks, any reversals, you look at the volume on the up candles. Do you have more red volume as you go down and it's rising, as opposed to the green volume of the attempts to rally? That will help keep you in this move. And then you can use the levels to decide, well, where do you think you want to come out at a point where you think, do you know what? Because this is, I fully accept, this is hindsight. This is hindsight. And it's always easy to see it in hindsight because, yeah, I mean, get in here, come out, maybe, I don't know, come out there. The volume is falling away again because you need volume to go down. You think, yeah, we're going to get a reversal. We do get a reversal. Yes, we get a reversal here, but the volume is, yeah, it's not too bad. You don't get a lot of volume on that that down bar. But look at that candle there. You don't get a lot of volume under there. But at the time, you think, well, if you did get in there and you're down to this point, you think, do you know what? I'm really not sure because this could actually move higher. There's a very strong platform of support under here. So looking at this in real time, which I think, I'm not sure we can do actually. Let's see if I can do it. There we are. Let's take out there. Yeah, you're seeing that, okay? And you think, okay, that's fine. I've been happy with that because I can see that those two there, I was a falling volume, not a lot under there. That's quite, that would have been a little bit, okay. But yeah, you stick with it because you've got some resistance up there. Maybe on another time frame, there was a Camarilla level. I'm not going to check that now at the moment. And then the downward trend resumes again. Maybe here you might think, gosh, there's a wick under there, and okay, you stick with that. But then you hit this support level and you come out. Now, bringing it back again. Oh well, I should have stayed in because look at that. Yeah, it carried on lower, then it carried on lower, and I could have stayed in it. No, you wouldn't. And you say, well, what's the point in looking at historic charts like this when 2020 hindsight is wonderful? And the reason for doing it is the volume price analysis setups, we call them, anomalies. They recur. They happen on all charts. So it may not be identical, but an anomaly is always an anomaly. And it's a great way to learn. You study them. So when you see that repeating somewhere else and you put it together with your multiple time frames, and also you would have more than one monitor. I can only show it on one here. And you look at what's happening on the daily chart, and you look at what's happening on the hourly chart. We have this big resistance here at 421, which corresponds with the resistance here on the 200 MA on the hourly. You're also hitting, as I said, the third level and the fourth level are the most important, but all the levels of the Camarilla, they will do something. The price will pause there. It may bounce off there more strongly off the third and the fourth. So you put it together as a complete picture, and that's all you can do until you are ready to look at these charts at what we call at the live edge of the market. I mean, we will do a session where we will look at the live edge of the market, and I'm going to pass over to David now, and he does it at the live edge of the market. But the historic, the hindsight, looking for the patterns, marking your chart up, even on trades that you've taken, because you do miss things because the markets are moving and you're very emotional, as we all are. You have to learn to manage those emotions when you're trading. Sometimes you can't see everything, and you look back and you look at it, and you look at your marked up chart, and you look at the historic price action. And because it will occur, it will recur. It does. It just repeats all the time. So that's what I wanted to say about volume price analysis and today's SPY. You may have noticed as well this indicator that I have under here, which is called the VRSI, which is the volume relative strength indicator, but I'm not going to talk about it. I'm going to let David do that because he has it set up in a very particular way. And before I pass over, I just want to tell you, this is the podcast. Oops, there we are. There's me. It's Confessions of a Market Maker. It went up yesterday. It's an hour and 25, and it was a pretty wide-ranging chat. And this guy, they both are. They're fascinating. And I just wanted to know VPA, macro, trading psychology. It was just a very pleasant chat with two very experienced traders. So if you want to go and have a listen, you are more than welcome.